Imagine losing $500 million in a single strategic decision. Not the fraud, not the scandal, not a bad luck, just a decision made by the smartest executives in one of the most trusted U.S. companies in real estate. This is Zillow. And in 2021, a single strategy that looked bulletproof destroyed over $500 million. The question isn't why they lost. The question is, could this happen in your company, your industry, even your decisions? And here's the part nobody talks about. The red flags were subtle, the warnings quiet, the opportunity for course correction fleeting. And yet, almost everyone missed it. Zillow wasn't a risky startup. It was a public company, trusted by millions of Americans. It shaped neighborhoods, pricing, and the housing market itself. When it made its move, the world believed it was smart, inevitable, and safe. Almost no one questioned it. Almost no one saw the danger lurking behind the data. But if Zillow could be wrong, it raises an uncomfortable question. Who else might be wrong? Right now, in your industry, your market, or even your own business. In 2020 to 2021, the U.S. housing market was unlike anything anyone had seen. Interest rates collapsed. Demand exploded. Homes sold in days, sometimes hours. Prices were rising faster than wages, inflation, or expectations. For most companies, this would create panic. For Zillow, it looked like clarity. Algorithms trained on millions of listings. Data predicting prices with surgical precision. If housing could ever be systemized and scaled perfectly, this was the moment, and Zillow believed it finally had the tool to do it. Everyone else thought they were right. But sometimes, everyone being right is the most dangerous position of all. By mid-2021, Zillow's leadership believed they had uncovered a once-in-a-generation opportunity. The company would buy homes directly from sellers, using data to predict market value and resell at a profit. It wasn't a gamble on paper. It was a calculated, algorithm-driven strategy. Executives called it bold. Analysts called it visionary. The promise: we can scale the housing market, make transactions frictionless, and dominate the industry. What they didn't know: algorithms can only predict the past. Markets move faster than models. And when Zillow began buying thousands of homes at peak prices, the consequences were invisible at first, hidden behind spreadsheets, dashboards, and confidence. Investors cheered. Analysts doubled down. The market believed in Zillow's math. This is scalable. This is inevitable. The headline said, millions of Americans trusted Zillow to price their most important asset, their home, and internally, the team felt invincible. Every metric they checked reinforced the strategy. Yet, the most critical question was missing. What happens if the market shifts just a little faster than our models predict? This tiny oversight, invisible to executives, ignored by analysts, dismissed by confidence, would soon become catastrophic. Here's where it all began to unravel. The Zillow model assumed that home prices would continue to rise steadily. It assumed buyers would be predictable. It assumed supply would remain limited, all of which seemed reasonable, until reality intervened. Small fluctuations, subtle shifts in demand, rising mortgage rates, tiny ripples became waves. Homes bought for profit suddenly became overpriced. Algorithms flagged nothing. Executives reacted too late. The invisible enemy? Complacency disguised as confidence. Some inside Zillow saw it coming. A few analysts, quietly reviewing the metrics, noticed homes were selling slower than projected. Margins were shrinking. Inventory was piling up. Yet, their warnings were buried under optimism. Meetings moved fast. Decisions were public-facing. And that's the cruel truth of business. The right warnings often arrive too quietly, too softly, for anyone to act. By the time the first public cracks appeared, billions were already committed. The question was no longer could they recover. It was how much would they lose. By late 2021, the housing market began doing something Zillow's models were never trained for. It slowed, not dramatically, not suddenly, just enough to matter. Homes stayed listed longer. Price reductions quietly increased. Buyers hesitated instead of competing. For a normal homeowner, this was manageable. For Zillow, holding thousands of homes purchased at peak prices, It was a structural threat. Every extra day a home sat unsold wasn't just time. It was capital locked, cost compounding, and margins collapsing. And yet, from the outside, everything still looked fine. Zillow didn't just buy homes. It accumulated them. Thousands of properties across multiple cities, each with taxes, maintenance, financing costs, and market exposure. What had once looked like an asset became something far more dangerous. Inventory. Unlike software, homes don't scale cleanly. They age. They depreciate. They demand cash. And the moment Zillow realized it was holding too many homes at the wrong prices, it faced a brutal reality. Selling quickly meant taking losses. Holding longer meant risking even larger ones. There was no painless exit. Inside Zillow, the tone began to change. Meetings that once focused on growth shifted to risk. Dashboards that once showed confidence now showed exposure. The same data that justified the strategy was now revealing its limits. Algorithms hadn't failed completely. They had simply been too confident in a market that refused to behave. And by the time leadership fully acknowledged the problem, the scale was already overwhelming. The question was no longer whether the strategy worked. It was how fast they could unwind it. In November 2021, Zillow made the announcement. It would shut down its home buying business entirely. Thousands of employees would be laid off, entire teams dissolved, billions in ambition reduced to damage control. The official explanation was careful, measured, corporate, but the reality was simple. The model couldn't survive a changing market, and exiting late made the cost far higher than anyone expected. When the dust settled, the number became unavoidable. More than $500 million lost. Not theoretical, not paper losses. Real capital, real people, real consequences. Zillow survived, but permanently changed. And for every executive, investor, and founder watching from the outside, the lesson was unsettling. This wasn't a reckless company. This wasn't a foolish decision. This was a reasonable strategy that failed because the world changed faster than assumptions, which leads to the most important question of all. It's tempting to say Zillow failed because the algorithm was wrong, but that explanation is too simple and too comfortable. The real issue wasn't bad math. It was overconfidence in what math could control. Zillow didn't misread the data. It misread the limits of data. Housing isn't just numbers. It's human behavior, emotion, timing, fear, and patience, variables that shift quietly, then all at once. The mistake wasn't building a model. The mistake was letting the model become the decision. And once it happened, every human instinct to slow down, question assumptions, or pull back was overridden by momentum. Here's the uncomfortable part. Inside Zillow, there were intelligent people who sensed the risk. But stopping a strategy at that scale requires more than insight. It requires permission to be wrong early. Once billions are allocated, once public expectations are set, once investors are watching, pulling back feels more dangerous than pushing forward. This is how rational organizations drift into irrational outcomes. Not through ignorance, but through commitment bias. Everyone assumes someone else has stress tested the risk. And slowly, the cost of stopping becomes higher than the cost of continuing. There was a moment, one moment, when this story could have ended differently. Not a dramatic event, not a crisis, just a decision to pause, to slow acquisitions, to reduce exposure, to admit uncertainty while the market was still forgiving. But in fast-moving markets, hesitation looks like weakness. So Zillow pressed forward, and that single choice to continue instead of recalibrate quietly locked in the outcome. Most failures don't happen because of one bad decision. They happen because of one good decision made for too long. Zillow survived, but the decision left a mark, not just on a company, but on how modern businesses think about data, scale, and control. Because the real lesson isn't about real estate. It's about what happens when intelligence creates confidence, and confidence replaces caution. And that leads to a final uncomfortable question. If the smartest people with the best data and the most resources couldn't see this coming, what assumptions are being trusted right now inside other companies, other markets, other boardrooms that haven't been tested yet? Zillow's story is an anomaly. It's a pattern that quietly repeats across modern business, especially in data-driven companies. First comes mastery. A company understands a system better than anyone else. It builds confidence, credibility, and momentum. Then comes expansion. The same logic, the same models, the same assumptions are extended into environments that look similar, but behave very differently. At first, it works. Early results validate the decision. Success reinforces belief. And that's where the danger begins. Because systems don't fail loudly. They fail gradually, while still appearing functional. Zillow didn't lose control because it moved fast. It lost control because it moved fast for too long without redefining risk. By the time the pattern becomes visible, the company is already inside it. Here's what most postmortems miss. Warning signs rarely feel like warnings in real time. They feel like temporary friction, market noise, execution issues, short-term headwinds. Inside organizations, these signals compete with something far more powerful: momentum. Momentum creates its own logic. When growth has already been promised, when capital has already been deployed, when public expectations are already set, stopping doesn't feel cautious. It feels irresponsible. And so decisions continue, not because leaders are careless, but because the cost of stopping feels higher than the cost of continuing. Zillow didn't ignore risk. It normalized it. And normalization is how intelligent companies drift into outcomes they never intended. Zillow survived this decision. Many companies don't. But survival doesn't mean untouched. Because every major loss leaves behind something more valuable than capital: perspective. The real lesson isn't about algorithms or housing. It's about the moment when confidence stops being questioned. The moment when speed replaces reflection. When success silences skepticism. When smart systems go unchallenged because they've worked before. Those moments don't announce themselves. They look ordinary. They feel reasonable. They pass quietly. If you want to understand how decisions like this are made before the consequences are visible, this channel exists for that reason. Not to predict the future, but to recognize the patterns that shape it. Because the most expensive decisions in business are rarely reckless. They're the ones that make sense. Until they don't, this is the moment where the story stops being about Zillow and starts being about every decision maker watching. Imagine standing in a boardroom, billions at stake, algorithms humming, analysts nodding. The market is moving faster than anyone can see. The question is not whether you have the right data. The question is whether you know when to doubt it. The difference between survival and loss is rarely obvious. It's hidden in the small decisions, the ignored hesitations, the quiet what-ifs. Zillow's $500 million loss wasn't flashy. It wasn't a scandal. It was a predictable cost of unquestioned confidence. And here's the critical truth. The best leaders, founders, and investors don't chase perfection. They chase awareness. They watch patterns. They pause. They act before the crowd realizes there's a problem. That's what separates companies that thrive through downturns from those that collapse. And that's why this channel exists. Here, we don't just report mistakes. We reveal the patterns, the signals, and the choices that determine survival. So if you want to understand the invisible rules of business, the ones that protect against millions in losses, the ones that the media never teaches, the ones that are quietly shaping markets as you watch this video, subscribe, follow closely, and watch every detail. Because in business, the difference between insight and regret is often one decision.